Every single day you are being lied to about the housing market. If you go online right now, it seems like there is a constant barrage of people telling you that we are headed for a housing market crash and a foreclosure crisis on par with what happened in 2008. We're at a very confusing point in the housing market right now, both nationally and locally in Denver, Colorado, where I'm at. We had an unprecedented run-up in home value appreciation for 2.5 years, and then all of a sudden, last year in 2022, interest rates shot up and it seemed like things just ground to a halt. It's very confusing, very odd feeling, and for some people, it's scary. So I get bracing yourself for some sort of collapse. Prices went up so much and now interest rates are up and we have a real issue with affordability, which is an absolute truth. So clearly there must be a crash of some sort on the horizon. The problem is when you dig into the data, they don't really support that. And I want to look at that data with you today. So first of all, there are 3 major factors that need to be present for a housing crisis to happen, a crash like we had back in 2008 in the global financial crisis. Number 1, there needs to be a dramatic oversupply of homes. We need to be tilted in favor of supply more so than demand. For prices to fall a significant amount, there needs to be an inversion in the supply and demand curves, right? It's basic economic stuff. Well, the market needs to be tipped in an imbalance in favor of supply. That's number 1. Number 2, there needs to be a widespread economic slowdown or recession, something that causes large-scale job loss and unemployment to go way up. And number 3, there needs to be a lack of equity in homeowners' homes. So this goes with the foreclosure idea. There needs to be a lack of equity across the board because if there's no equity when this economic event happens that causes this widespread job loss, well, now you can't afford to pay your mortgage anymore. If you don't have any equity in it, that's when foreclosures come into play and the bank can foreclose on your home. If you have equity, anything significant, well, you just sell the house if that happens. You take your money and then you go somewhere else. So let's look at where these 3 factors are right now in the Denver, Colorado market and the housing market as a whole. First of all, real quick, I want to look at where foreclosures are right now. So this is FRED. This is the St. Louis Fed. This is one of the best resources for real estate and housing market data. This is a graph charting foreclosures from the early 90s until now. And as you can see, now we are very, very low. This big jump. Okay, this is what happened after 2007, 2008. In late 2007, they were at about 3%, just over 3%. Right now, we have them at 1.72% at the last reading on this graph. So significantly lower than they were before the crash of 2008 and historically very, very low. And the reason for this is because homeowners have so much equity. When you get this big run up in appreciation, anybody who's been in a home from 2019 or before, well, they have a ton of equity in their house. They're kind of sitting on a gold mine, leading to very, very low foreclosures. Does that mean foreclosures can't go up? Of course not. They just haven't yet. And when I say they haven't yet, you may say, well, Sam, it was in the news that Denver foreclosures actually jumped quite a bit. Aha, that is true. Here is the graph. From 2021 to 2022, Denver foreclosures almost quadrupled. You see in 2021, they were at 112 in the Denver metro, and then they jumped all the way up to 398. Big jump. The big difference is, let's look at the rest of the graph. Yes, they were higher than in 21. They're still extremely low, historically low. We're talking about 400. In 2007, they were at over 8,000. Even going back to 2000, 2001, they were twice or 3 times as much than they were in 2022. So it's a little misleading. They did go up a lot. They're still historically very low. Moving on to those 3 factors we need to cause a housing crisis. Number 1 is unemployment rate to go up. There to be widespread job loss. We're going back to our friend Fred here in St. Louis. This is the unemployment rate since the mid 80s. You look over here and see we are at 3.5% at last reading. 3.5% is basically fog, a mirror, get a job. It's extremely low. Oh, something happened here in 2020 that it shot way up. Otherwise, unemployment's been really low for a while. You see how high it went in the financial crisis, up to around 10%. But even before that, it was at 4.5%. So a fair amount higher than it is now. Again, does this mean just because it's low now, it won't go up? No, I actually expect it to go up sometime in the next couple of years. It has been so low for so long, and the government is kind of trying to will a recession to curb inflation. That's the reason they keep raising the Fed fund rate, and mortgage rates shot up so quickly because inflation got out of control. To curb inflation, they need people to spend less money. For people to spend less money, the economy needs to contract. Or maybe the less spending of the money causes the retraction. Whatever. That's what the US government wants to happen right now. And depending on who you listen to, it seems likely that even if we don't have a full-scale recession, there still is something coming, and we haven't seen the worst of it yet. The Fed just keeps raising rates. A lot of people expected mortgage rates to be much lower than they are by now, but the economy isn't responding the way Jerome Powell wants. So at least what they're saying, they're going to make us feel the pain until we feel the actual pain. So I expect unemployment rate to go up by a significant margin. Is it going to be enough to get to this range where it's going to be a factor in a eventual housing crash? Well, that remains to be seen. Right now, extremely low. We got a long way to go. Next, looking at Megan Aller's numbers here. If you follow this channel at all, you know I look at her stats a lot. She's the #1 title rep in the country, and it's not close. This is inventory in the Denver metro, okay? There's a lot going on here, so don't get confused, but basically what we're looking at is the blue area over here. That is active inventory. That's how much inventory we have in our housing market. So active inventory at the last reading is at 42, almost 4,300 in the Denver metro. Important point to look at is that we measure supply not only in the number, but in months of inventory, so months of supply. And theoretically, for a balance, a completely balanced market between a buyer's and seller's market, it's neither one. It's completely balanced. That's 6 months of supply. Right where our number is, that's about 1.6 months of supply. So nowhere near what we need for balance. But still, if you look at it, it got really low in 2020 into 2021, and now it's a bit higher. Inventory has come up, which really was a good thing for the health of the market. If you were out there during that time, it was impossible as a buyer to get into a house. Interest rates are great, but inventory was so low because there were so many buyers out there. Demand was so high, and that pushed the supply down. Every new house that would come on the market would get snatched up immediately. But historically, our inventory, if you look at this graph, is still very low right now. If you go back to 2007, 2008, even back to 2006, it was above 20,000 units. So that is an oversupply. 20,000 units, 4,300 units, no comparison whatsoever. And what's kept this inventory so low is even though fewer new homes are coming on the market and fewer sales are happening than they were a year ago, well, sellers just aren't selling because of interest rates. Imagine if you're locked into a 2.75 interest rate, if you don't have to move, are you going to move and get a mortgage at 7.2? Probably not. The people who are moving right now are having to move. So supply is kept low by that. Demand is still pretty strong, but demand has come down too. Obviously, demand is less in a 7% interest rate environment than it was in a 3% interest rate environment. So there are fewer buyers out there, and that has caused home prices to come down a bit. They've come down about 6-7% year over year from last year to now. But since sellers aren't selling, those interest rates are keeping supply low. Well, okay, could this change? Of course it could change, and supply could shoot up. But what's going to happen? Okay, Sam, you're telling us that since sellers aren't selling, since interest rates are high, that's keeping supply low. What happens when interest rates drop? Will supply go up? Will inventory go up? Will sellers all of a sudden start to sell? Yes, sellers are going to be more open to selling because they'll be able to buy their next place. Thing is, more buyers are going to come out too. So there will be more supply theoretically, but then demand is going to go up too. A lot of buyers are having an affordability issue right now with interest rates. The monthly payment just doesn't make sense. When the interest rates go back into the mid fives, there's going to be a lot more buyers out there. So supply could go up, but demand is going to come up with it. The last thing is equity, and equity in your home. I mentioned how important this is for avoiding a foreclosure crisis. Even those other two factors are present. If they are present, then having equity can avoid widespread foreclosures. Well, this is a graph of equity in homeowners in America since the mid 80s. And you can see it's very high. Has it come down from its absolute peak in Q2 of 2022? Yes, but that was probably a necessary correction. And that's the truth of a lot that's happened with the housing market in the last year. It really has been a necessary correction because did prices come down around 7%? Yes, but that's not nearly enough to account for the 30 to 35% run up we had the years before that. We probably need even a little bit more of a correction that hasn't happened yet because supply is so low, keeping those home prices up. For a balanced, healthy market, for a market to be more normal, we probably even need a little bit more of a correction on home prices, which hasn't happened yet. So I wouldn't be surprised to see home prices drop a few percent year over year between now and next year. I wouldn't be surprised to see them stay flat either. Things have started to calm down and started just to relax because of all the crazy craziness that happened that couldn't continue. That sort of appreciation was never sustainable long term, and it shouldn't be sustainable. We needed a relaxing to happen. A relaxing is happening, and I expect it to continue. So even if home prices do drop a little bit more now into next year, that's probably healthy for the market. And that surely doesn't indicate a housing market collapse or a crash of any sort. A crash would be a drop in home prices of 30, 35, 40%. Exactly like what happened in 2008. That would wipe out all the gains from 2020 to 2022. There's no indication that even has a possibility of happening now. Again, never say never, but it's just highly unlikely based on what the data say. One more thing I want to touch on, because I did mention the affordability issue. That is a real issue right now. If you want to talk about a crisis, there is a affordability crisis for home buyers in America right now because of where interest rates are and because of how fast and how much home prices rose. Low supply has kept those prices pretty darn high. Well, that creates for a real affordability issue, especially for first-time home buyers. We're talking about having to pay $3,000, $3,500, $4,000 a month for a starter home in this interest rate environment right now. The longer houses stay on the market, there's opportunities for negotiation, to get buy downs on the rate from the seller, to get them to pay for that, to get concessions to drop that interest rate and drop that monthly payment, at least in the short term. But the reality is, it's a challenge if you're trying to buy a house right now. And based on that, one might think, okay, well, this is what's gonna cause the foreclosure crisis. Say what I assumed is gonna happen does actually happen, and there's some sort of economic recession that does cause employment to go up. Well, then all these people who are locked into these 7% interest rates, if those rates don't drop and they're not able to refi, well, then they could be the ones going into foreclosure because they're having a problem affording those monthly payments right now. And theoretically, this is true. Problem is, that's not a very large sector of homeowners. Going now to a Bankrate article real quick, this talks about a lot of what we're talking about today, how most of the experts are saying that it's unlikely there will be a housing crash. Well, they talk about the typical homeowner now. Tons of equity, stellar credit, and a fixed rate mortgage locked into well below 5%. In fact, according to a study, 82.4% of all current homeowners are locked in below the 5% mark. That means 82% of homeowners in America have a mortgage they have no problem affording whatsoever. These are the people who aren't moving. And even if they are falling on hard times economically, that's a much better position to be in from an affordability standpoint on your home than anybody getting a mortgage right now. And that's the vast majority of homeowners in America. There's more to this, guys. There's more data about builders, how they're not building nearly as fast as they did prior to 2008 because of restrictions and red tape and supply costs and all those things. We could talk about how mortgage standards have changed completely, where beforehand they had kind of honor system loans where you said, yeah, I kind of make this much money, and you didn't actually have to produce documentation and they'd still give you a loan. That all has gone away because that type of lending is really what caused a global economic crisis. Now, as anybody who's bought a house in the last few years knows, it's actually very difficult and very stringent of a process to get a mortgage. Even if you are well qualified, it's almost annoying how much they ask for. My friend Pete calls it financial undressing. That's what it feels like. It is a very, very stringent, very thorough process, much different from what it was in 2007 and before. But the truth is, nobody has a crystal ball. Nobody can predict the future. All we can do is look at the data and go on what the data say. And right now, the data say we don't have the environment that would cause a housing market collapse. It just isn't in the cards. Is it impossible? Absolutely not, but it's definitely not probable. Things are going to be interesting over the next few years. Interest rates are going to play a big, big part in what happens. And there's not a whole lot we can do about that. We will see what the Fed and Jerome Powell continue to do. We will see what the jobs reports continue to do. We're going to find out. But right now, housing remains strong, if very, very weird. Hopefully this is helpful. If I could do anything for you at all, I would love you to reach out. Those of you who have watched the channel know it is my goal to be your go-to real estate resource. I love talking about this stuff, and I would love to talk about this in person with you. So reach out. Otherwise, I love all of you. Talk soon.